Welcome back to your weekly roar. We're back here to fill you in on what actually matters, cut through the noise, and give you something you can use right now. So let's do that. I'm Dustin.
And I'm Brandon.
Today, we're getting into a phrase that I think is going to matter more and more over the next few years. Liquidity is the new equity.
And that's a big statement because for a long time, everybody wanted equity. Equity meant ownership. Equity meant upside. Equity meant I got in early. Equity meant you had a piece of the company, you had a piece of the project, you had a piece of the future.
Exactly. But in Web3, we're seeing something bigger emerge. Ownership still matters. Equity still matters. Tokens still matter, but liquidity is becoming the real operating system because liquidity is what lets money move. It lets users buy, sell, stake, earn, spend, bridge, settle, and participate.
And that connects directly to stablecoins, tokenization, AI agents, payments, and what we saw coming out of Consensus 2026 in Miami. The conversation is changing, and the market is not just asking, what token can I hold? It is asking, what can move, what can settle, what can be used, and what can be trusted, what can unlock commerce.
And that's where things get important for Roar. A lot of folks been asking us over the last weeks, what's this matter for Roar? Because when we talk about future stablecoins opportunities, wallet infrastructure, Roar Chain 2.0 launch pads, DeFi tools, AI commerce, and tokenized ecosystems, we're really talking about liquidity, not just price, not just speculation, liquidity.
So if you've ever wondered why stablecoins are becoming such a big deal, why Michael Saylor and Strategy's digital credit model is getting attention, and why institutions are suddenly talking about tokenization, or why Roar keeps focusing on wallet utility and ecosystem rails, this episode is for you.
Yes, let's get into it. Okay, this week's spark is simple. In the old world, equity was power because ownership was scarce. In the new world, liquidity is power because movement is scarce.
And that's good because people hear liquidity and they think it just means trading volume. And yes, trading volume is a part of it, but liquidity is bigger than that. Liquidity means access. It means speed. It means availability. It means being able to move more value when and where it's needed.
Right. A company can have a massive valuation and still be stuck. A startup can be worth $100 million on paper and still have no usable capital. A token can have a great story and still be hard to buy, hard to sell, hard to use, and hard to trust. And that's the problem that liquidity solves. By the way, that's why in the very beginning, we locked away liquidity in our very starts while we did it the way we did it, so that even in down markets, that we were still very liquid and our token could do what it does.
That's right. And it's one of the biggest differences between traditional equity and digital assets. Traditional equity is powerful, but it is often slow. It lives inside transfer agents, brokerages, settlement windows, lockups, accredited investor rules, private markets, paperwork, and a lot of friction. But crypto assets, when they are designed well, can move globally 24/7 through wallets, through smart contracts, DeFi rails, and stablecoin settlement.
That's why stablecoins matter. Stablecoins are not just crypto dollars. They're the cash layer of the digital economy. Bitcoin may be digital capital. Tokens may be network ownership or utility. NFTs may be access and identity. But at the end of the day, stablecoins are the real liquidity layer that lets the whole system transact.
And that's why the conversation at Consensus 2026 matters. Consensus was not just about hype coins. The big themes were stablecoins, tokenization, payment infrastructure, institutional DeFi, real-world assets, AI, and policy. That tells you where the serious money is looking.
Exactly. The serious money is looking at settlement. So it's looking at payments, it's looking at tokenized ownership, it's looking at how dollars move on chain. It's looking at how businesses can operate with faster, programmable, borderless liquidity. And that's a very different market than the one that was just chasing memes. And I want to go a little deeper here, just real quick. A little sidebar. We have done a lot of consulting with businesses and banks and financial institutions who think that things have value in the equity world, in our digital world, without liquidity. And we've said over and over, it does not matter if you have no liquidity. There's no real tagging that to a value. You can't peg it and you can't really use it. That movement is the value. The function and movement is the value. And we're going to get on into that.
And that brings us to our quick take. So here's the thing that most people get wrong. They think liquidity is something you worry about after the product works. But in Web3, liquidity is part of the product.
That's the key. That's the key. For a Web3 ecosystem, liquidity is not only what happens on an exchange. Liquidity affects user experience. Can users get in? Can users get out? Can they pay? Can they earn? Can they bridge? Can they settle? Can they use a token inside the ecosystem? Can businesses accept value without taking unnecessary volatility? Can rewards flow in something stable enough to be trusted? And I'll be honest with you, even though I don't love this down market and this winter season, even though we as our token and our utility is trading way under what I believe is the actual value against what we have in actual build, software licenses, revenue, and more, let's be clear, that is all true in our current moment right now for Roar. And that's exciting because that's something you can build on. So at the worst case scenario, hey, we can build here. That's awesome.
And that is where stablecoins become so strategic for Roar as well. Because if we're building around wallets, launch pads, DeFi, business in a box systems, AI commerce, and tokenized access, then we need to think about the stable value layer, not as an afterthought, but as infrastructure.
And that's why early on with even the Roar chain, we immediately went to the Optimism USDC standard for USDC.E and built a stablecoin right against Circle. So it's one-to-one legitimately there. That's why we were going to do that at the very least. And now we're going to do more. And this is why liquidity is the new equity matters. Equity says I own a piece. Liquidity says I can move value. Now, if you don't get that, that's okay. But if you're in a financial position, if you're transacting and sending money across the planet, or if you're in a banking world, that is a problem. You need to understand because that core piece is the biggest, most meaningful thing to the whole discussion. Equity says I own a piece. Liquidity says I can move value, actual value. Equity says I may win later. Liquidity says I operate now. Boom, it's powerful. Equity is about upside. Liquidity is about utility. So that's it in a nutshell.
And the next generation of Web3 platforms will need both. But if you have equity without liquidity, you have a story.
That's true. How many times have I said that, dude?
We have met some people. I'll tell you what. They just don't get it.
Yep.
If you have liquidity with real utility, you have an economy. And that's a powerful statement. Before we get into the next part of this, this might be a good moment to grab coffee or reset. And because of what we're about to get into, goes a layer deeper.
Let's do the deeper dive. All right, going deeper. The stablecoin conversation is changing fast. I mean, this is one of the fastest moving conversations we have right now in this world. A few years ago, stablecoins were mostly treated as a trading tool. People used USDT or USDC to move in and out of positions, park value, or get around slow banking rails. And that worked. It did. We've done that. That's what we've had to use. But now stablecoins are becoming payment infrastructure. This is crucial.
And that is a major shift because if stablecoins become mainstream payment rails, they can impact almost everything: merchant payments, payroll, remittances, rewards, online commerce, treasury management, DeFi, and even AI agents making transactions. And when you connect stablecoins with wallets, tokenized assets, and smart contracts, you get programmable money. That means a payment can be made more than a payment can be more than a payment, right? It can trigger access, it can settle a trade, can release digital product, it can pay a contributor, it can fund a DAO treasury, it can move through a launch pad, it can reward a user, it can be routed by an AI agent, it can connect directly to an on-chain identity.
And that's where the Michael Saylor and strategy conversation becomes interesting. We really took notes on this at Consensus 2026. To be clear, the cleanest source trail is not Saylor personally launched a stablecoin on stage at Consensus. The more accurate version of what really happened, and we were there to hear it, is strategy has been building a Bitcoin treasury and digital credit model. And their STRC is part of that capital structure. It's a preferred security designed to produce cash dividends. And now protocols like Saturn and others have been building stablecoin style products around that digital credit idea. And really, there's an opportunity for builders like us, Roar, Saturn, and others, to take advantage of the spread that happens inside of that narrative. There's a very good value there.
That was quite a gift that he gave everyone.
That's insane.
And it's important too, because it shows a shift in how people are thinking about stable value. A stable coin does not have to only be a boring dollar wrapper. It can become a bridge between digital assets, credit markets, yield, and liquidity. Now, there are risks. We should say that clearly. Yield-bearing stablecoins, credit-backed stablecoins, and synthetic dollar products need careful design, reserves, transparency, compliance, and risk controls.
Absolutely. I mean, without a doubt, we have seen what's happened to products out there that have tried unique views at yield-bearing stable coins, as well as stable coins that were backed by the wrong things. We've watched that happen. I won't get into names, but I know of a couple amazing projects that were highly funded, highly touted, and worldwide that totally crashed and went under. So that doesn't change the fact, though, that the big idea is powerful. And Saylor's been making the argument that Bitcoin is digital capital. And then Strategy's model starts pointing toward digital credit. And stablecoin builders are asking, can we turn some of that into usable dollar-denominated on-chain liquidity? So that's a big moment because it connects Bitcoin, credit, stable value, and DeFi into one conversation. That's why we're involved in it. Because, hey, that sounds like our stuff.
And that's exactly why liquidity is the new equity. Because in the past, the big question was, who owns the asset? Now the bigger question is becoming, what can that asset support? Can it support credit? Can it support payments? Can it support stable value? Can it support commerce? Can it support an ecosystem? Can it support global user base?
That is the Roar perspective. We're not just thinking about a token sitting on a chart. We're thinking about an ecosystem where the wallet becomes the entry point, the token becomes a utility layer, stable coins become the transaction layer, NFTs become access and identity, and AI agents help users navigate the whole thing. All of what we're building is on that.
Absolutely. And that is where things start to click, because a future Roar stablecoin strategy could support a lot of different use cases. It could help users transact without taking token volatility on every action. It could help business price services more clearly. It could help power launch pads where projects raise, settle, and distribute funds more efficiently. It could support reward subscriptions, treasury flows, staking interfaces, and commerce inside Biz-in-a-Box or MediaQuake style business systems.
And for AI commerce, stable coins are almost required, because if an AI agent is going to execute tasks, recommend purchases, route payments, or manage business workflows, it needs a reliable transaction layer. You don't want every AI-driven transaction exposed to volatile pricing. You need stable units of account.
And that's one of the biggest pieces. AI agents do not just need intelligence, they need rails. They need identity, permissions, wallet infrastructure, stable payments, spending limits, audit trails, and they need settlement.
And so that puts Roar right in the middle of a major market transition, because Roar is not only about a token, it's about building the rails around token utility, wallet, chain, portal, launchpads, NFT access, DAO tools, AI, business systems, AI infrastructure, AI OS, and potentially stablecoin infrastructure as well. I say potentially, but definitely, because we've already built it.
And let's be honest for a second. The projects that only focus on price will keep chasing attention. But the projects that focus on liquidity can build economies. And there is a huge difference.
Yeah. So price is a signal. Liquidity is a system. Price tells you someone will pay today. Liquidity tells you whether the ecosystem can actually function, which, by the way, pat yourself on the back, Roar community, it functions. That's why a project with shallow liquidity can look exciting, but still be fragile. We've seen them come and go. Especially now, you can see who can still exist. And a project with deep, trusted, well-designed liquidity can become durable. That's what we're doing.
And this is why regulation matters. Stablecoins are moving into a more regulated phase. That can feel frustrating for some parts of crypto, but it also opens doors because institutions cannot build serious payment systems on uncertainty forever. Banks, fintechs, merchants, funds, and public companies need rules. So they need reserve standards. They need compliance. They need auditability. They need clarity.
Yes, and once those rules become clearer, stablecoins can move from the edge of crypto into the center of digital finance. No, so just crypto on the side. They can move from the edge of crypto to the center part of digital finance, and they already are. When you got MoneyGram saying we've already gone to digital rails and we already use a stablecoin and it already is saving money, wow, this is happening. So stablecoins are more than just trading tools. They're becoming settlement infrastructure.
So the hot seat question is this. If liquidity is becoming the new equity, is your project building a token or is it building an economy? Because those are not the same thing. And a token can launch in a day. An economy needs rails.
It's huge. All right. Before we land this, let's take a second and think about how this actually shows up in your world, because the next piece is where it all starts to connect.
So let's bring this home. What does liquidity is the new equity actually mean for Roar? First, it means we cannot think like the old market. The old market said, launch a token, get attention, chase prize, hope people stay. The new market says, build utility, build liquidity, build trust, build rails, and give people reasons to use the ecosystem every week.
Yes. Second, it means stablecoins matter. A Roar stablecoin opportunity is not just about creating another coin. The world does not need another random stablecoin with no purpose. The opportunity is to create or integrate a stable value layer that supports actual Roar ecosystem activity, payments, subscriptions, launchpad funding, treasury movement, business onboarding, AI commerce, wallet utility, rewards, merchant settlement, DAO participation, access to service, cross-border movement.
And third, it means liquidity strategy becomes part of product strategy. For example, if someone launches through a Roar-powered launchpad, how do they raise funds? How do they settle funds? How do they protect contributors from volatility? How do they distribute rewards? How do they support secondary markets? How do they give their community usable value? Stablecoins can help answer those questions.
And fourth, it means Roar can think in layers. So Bitcoin is digital capital to us. And I've said this so many times. I see this. It makes sense. And I'm just glad that Michael Saylor went from being a Bitcoin maxi only guy to actually seeing the value in the larger digital market because of this. But Bitcoin becomes digital capital. Stable coins are digital cash. Tokens are utility and network participation and function. NFTs are access and identity. AI agents are the automation layer. And then wallets are user interface. Liquidity is what lets the whole system move.
That is the architecture. And this is where the Saylor strategy model is worth watching. Whether someone agrees with every piece of strategy's approach or not, the big idea is this: digital assets are moving beyond buy and hold. They are becoming collateral. They are becoming credit. They are becoming income products, treasury tools, stablecoin infrastructure, and they are becoming part of the larger liquidity machine.
So that should make every Web3 builder pay attention. Like, I was in the crowd and I'm looking around, who are the builders in here? Because you can see they're few and far between because they weren't getting it. And it's just, when I heard, I was like, oh my goodness, pay attention. This is legit, because the question is no longer only what's your token worth. Question is, what financial activity can your ecosystem support? Can it support payments? Can it support credit? Can it support settlement? Can it support tokenized ownership? Can it support stable liquidity? Can it support real users and real businesses? This is what matters.
In 1 minute, here's what this really means. Equity is ownership. Liquidity is movement. Equity says you have a piece of the future. Liquidity lets you participate in the present. Equity can sit still. Liquidity creates activity. Equity can be locked up. Liquidity can flow. And in Web3, flow is everything.
That's the real shift. The next generation of digital economies will not only be judged by how many people hold the token, they'll be judged by how many people use the rails. So how much money moves through the wallet, how much settlement happens through the ecosystem, how many businesses transact, how many AI agents can operate safely, how many users can get in and out without friction, how much utility exists beyond speculation. That's what matters. And that's why we're talking even less and less about crypto and blockchain and what we've talked about. We're just building it as Rails and Web 2 products and rolling them out like business in a box and more.
And that's the roar line. So if there's one thing to take away from this, it's this: liquidity is the new equity, because the future belongs to ecosystems where value can move.
Exactly. There it is. Winners will not just be the ones with the best story. They'll be the ones with the deepest utility, the cleanest rails, the strongest liquidity, and the most trusted stable transaction layer. Listen, I've been here a long time, since the early days of Bitcoin. I've been here, been watching, been participating one way or another, just becoming vocal in the last 5 years and visible in the last 3. And I'll tell you this, there's a lot of folks who've had amazing stories and they are gone. A lot of projects are zombie tokens out there and they are gone. We are here in this season, still standing, still going forward, still liquid, and actually seeing opportunity instead of obstacles and problems. We're seeing exciting new world reality because we are not narrative. We are absolutely utility and function, and we get it.
And for Roar, that means stablecoins are not just a side conversation. They are part of the future of the wallet, part of the future of launch pads, part of the future of business in a box, part of the future of AI commerce, part of the future of how communities, founders, users, and businesses interact with digital value. Because if the wallet,
well, I mean, I'm just going to say, I want to jump in here, Brandon, because if the wallet is that front door,
yeah,
let's be honest, liquidity is the electricity. You may not always see it, but nothing works without it.
And that's this week's Roar. If this hits for you, share it with someone who needs to hear it, especially someone who thinks crypto is only about coins going up and down on a chart.
Because honestly, guys, the next phase is bigger than that. It's payments, it's stable coins, it's tokenization, it's digital credit, it's AI commerce. I'm so excited about AI commerce. I can't wait to fill you in on that later. It's coming up in one of our next podcasts. It's liquidity, and Roar is watching that future very closely. We're not just watching, we're building into it.
So be sure to follow our show on the platform you found us on. And if you like our podcast, rate and review. It helps the value, as well as the algorithms that make us easier to find. We need your help on that.
Until next time, stay sharp, stay curious, and keep moving forward.
This is your weekly Roar.
Boom.